So these are the few questions remaining from bonds, and let's first do them and then move on. This question says a corporation issued convertible bonds. Convertible bonds are the bonds that will be converted into common stock at some point in the future. So a corporation issued convertible bonds with a par value of $1,000. Okay, that's the par, the face value or the nominal value. The corporation stock is selling at $38 per share, and the current market price of the convertible bond is $1,050. If conversion ratio is 25, what will be the conversion price? Now, this is an interesting question. Remember, the price of the bond doesn't matter. The price of the stock doesn't matter, because the price of the bond keeps on going up and down. The share price keeps on going up and down. That doesn't mean that your convertibility will be affected. Convertibility doesn't depend upon the bond price or the share price. How do you calculate convertibility? The formula, please note down the formula. The formula is conversion ratio is equal to the par of the bond, bonds par, divided by the conversion price. This is the formula. Bond par is agreed when the bond is issued at the start and in the bond indenture, right? And the conversion price is also agreed at the start when the bonds were issued. And this will help you, this will calculate the conversion ratio. So it doesn't depend upon the bond price, it doesn't depend upon the stock price, it depends upon these two numbers which are already agreed to when the bonds were issued and the bond indenture was mentioned. So just need to plug in the numbers. Bond par, face value, nominal value is $1,000. We need to find the conversion price, CP. We have been given the conversion ratio 25. So make CP the subject of the formula. You get 1,000 upon 25. So that gives you 1,000 upon 25 will give you 40. So conversion price is 40, irrespective. The market price is 38 or whatever. So this is the conversion price. Now, something that you want to discuss now, you should discuss. Now, this is the conversion price, $40. Now, the market price of the bond is of the share is 38. The conversion price is 40. Now, it's your choice. Would you like to convert your bonds at a conversion price of 40, whereas the market price of the share is 38? It doesn't appear to be a good deal. But if the market price is $50 or $60 and the conversion price is 40, that's the right thing to do. It's more attractive then. So this is the formula you will use. I've just written a little while ago to find the conversion price, and you can compare this conversion price with the prevailing stock price, and then you decide, should you purchase or convert the bonds or not? Because conversion might be at the discretion of the holder. If the holder decides to convert, this is an important point here. The conversion price was $40, whereas the stock price is 38. Your conversion price is more than the stock price. In this case, you should not convert. Conversion price is higher than the stock price. But let's say if the stock price was 48 and the conversion price was 40, in that case, you should go for it. You should go for the conversion. And as I said, that the conversion of the bonds into common stock, not always, but sometimes it is in the hands of the holder. He may decide to convert. This formula, conversion ratio is equal to the bonds par divided by the conversion price. And conversion price basically is equal to par upon the conversion ratio. So this is how you calculate conversion price, this formula. So I've noted. Should I move on? Okay. Okay, next question. On December 30th, finance company sold a non-interest bearing bond requiring 10 annual payments of $10,000 each. There is no interest, but there will be $10,000 payments. This is what you call a serial bond. I hope you remember, serial bond is a bond that is redeemed in pieces. So there will be $10,000 payments every year, and there is no interest on this. Door company made the first payment on December 30th. The market interest rate for the similar bonds at the date of issuance was 8%. This is what you call the interest rate per period. This is the rate you would use for your discounting. Information on present value factor is given as follows. A number of periods, 9. The present value factor is 0.5. The present value of annuity is 6.25. If the number of periods are 10, discount factor is 0.46 and the annuity factor is 6.76. I'm sure you know what these mean. And if you don't, we will discuss this in detail in your section E, decision analysis on investments, NPV, IRR. So it's coming in detail over there. Here you just need to focus on how the bond is valued. Okay, now this bond doesn't pay any interest. Rather, it pays 10K payment every year for 10 years. It says in its December 31st balance sheet, what amount should finance report as bond receivable? You have to see whether there are 9 periods remaining or 10 periods remaining. For this, you need to read the information again. On December 31st, finance company sold a non-interest bearing bond requiring 10 annual payments of 10,000 each. Door company made the first payment on December 30th. First payment has been made. It means there are going to be now 9 payments in the coming period. And these 9 payments now needs to be discounted to find out the present value of the bond. 9 installments, Yusuf, you're absolutely right. So there are 2 ways you can do this. Since there are 10,000, single amount of $10,000, which is repeating in 9 periods, so you will multiply it with the annuity factor of 8% for 9 periods. Since there are 9 periods, so you will use this row, 6.25. So $10,000 multiplied by 6.25, this will give you 62,500. So these $10,000 payments, 9 payments that will be coming, 9 installments in the coming 9 years, they have this present value discounted at 8%. This would be shown as the amount of receivables on the balance sheet, bond receivable, 62,500. If you are the investor, this is what you will report on your balance sheet as a receivable against the bond. Now, if you insist to solve it using the financial calculator, and you know the inputs to the financial calculator are number of periods, interest rate per period, present value, payment, and face value. Let us do this now. Number of periods are 9. Interest rate per period is 8. Present value, we want to show it as on the balance sheet because we are investors, so we need to show what is the value of the bond right now to report on the balance sheet. And there are going to be 10 payments of 10,000 each, 10,000, 10,000, 10,000, and there is going to be no face value in the future because bond pays 10,000 every year and there is no final principal on redemption. So these are the inputs. If you plug in our financial calculator, let us see what do we get. What do we get? Plug in the numbers right here. We have 9 as N, 8 as your interest rate per period, and the payment is 10,000 positive because it's an inflow. You are an investor, you will receive this. So this is PMT. 0 is going to be your face value, Mafi, face value in the future. So compute present value, 62,468. 62,468, that is close to the number we have, 62,500. So that's the right option. So you can use it in the conventional way. You can solve it using the financial calculator. It's totally your choice which way you want to go. Okay, next question. Now this is a good one. On November 1st, Mason Corporation issued $800,000 of its 10 years, 8% terms bond dated October 1st. So the dated October 1st, issued on 1st November. Remember, dated on October 1st, issued on 1st November, which means there is 1 month interest in arrears. The bonds were sold to yield 10% with the total proceeds of 700,000 plus the accrued interest. Now listen, you issued bond with a face value of $800,000. It's a 10-year bond and the 8% term bond, this is the coupon. This bond is dated October 1st, which means the interest calculation will start from October 1st, even though the bonds were issued on November 1st. The bonds were sold to yield 10%. This is the effective rate you will use for discounting. A total proceed of $700,000 was received plus accrued interest. Interest is paid every year in April 1st and October 1st. Okay. What amount should Mason report for interest payable in its December 31st balance sheet? Remember, this is the bond liability, $800,000. You pay interest at the rate of 8%. Remember, the interest is paid at the rate of coupon multiplied by the face value. Coupon is 8%, face value is $800,000. This bond should start paying interest from 1st of October, but we issued the bonds on November 1st. Our first interest payment will be made on April 1st. But right now, what we are interested in, the interest computation will start from October 1st for November and December, and 31st December is our balance sheet date, which means we will have to calculate the accrued interest for 3 months from October, November, and December, even though the first interest payment will be made in April 1st, but we need to calculate the interest for 3 months period. So it's going to be $800,000 times 8%, $800,000 times 8% times 3 by 12. So the total interest you should accrue on your balance sheet as interest payable is 16,000, and that makes A to be the correct option. Right? Simple as that. You need to see from which date the interest is due. This one is good. On January 1st, year 2, our company issued 400 of its 8%, 1,000 bonds at 97. This is the convention we use in the market. 400 bonds, 8% is the coupon, 1,000 is the par value or the face value. Issued at 97 means a $100 bond has been issued at 97. There is a 3% discount. It's a discount bond. It's a discount bond plus accrued interest. The bonds are dated October 1st, year 1, and it will mature in October 1st, year 11. It's a 10-year bond. Interest is payable semi-annually on April 1st and October 1st. Accrued interest for the period from 1st of October, year 1 to January 1st, year 2 amounted to rupees 8,000. This is the accrued interest. We don't have to calculate it. What do we need to do? On January 1st, year 2, what amount should Oak report as bonds payable net of discount? Bonds payable net of discount. Apparently, it's a difficult question, but it is not. Remember, you have issued 400 bonds, each with a face value of $1,000, which means the par of the bond, 400 multiplied by 1,000, so it's $400,000. Since this bond was issued at 97%, at 3% discount, so its book value, net book value is going to be 97% of this number, and 97% of this number is going to be 388. We don't have to calculate interest. We just have to see what is the next bond payable net of discount. So this is the par of the bond, and this is the discount. 3% of 400,000, that is 12,000. So $400,000 less 12,000. This is the bond payable net of discount. If you ask me what is the bond payable is $400,000. Net of discount means net of 3%, that is 12,000, gives you 388. So this amount is what you call the bond payable net of discount. So that makes B to be the correct option. Next, on June 30th, year 4, Huff Corporation issued 100,000 of its 8%, 1,000 bonds at 99. This is the number of bonds, 1,000 bonds, 8% is the coupon, $1,000 is the face value, par value, nominal value. Issued at 99% means 1% is discount. So let us first calculate the overall par value of the bond issued. 1,000 bonds were issued, each having a par value of 1,000. So the total amount you should have collected is $1 million, but it's 99% mean you gave 1% discount. 1% discount mean you paid 10,000 as, or not paid actually, there's a 10,000 discount. The bonds were issued through an underwriter. Underwriter is a company or an investment banker or even an individual who brings the bond issue and charges a certain fee. So our underwriter charged $35,000 as the underwriting commission. Yusuf, excellent. Excellent. 35,000 is the underwriting cost. So what we have to find out, on June 30th, year 4, Huff should report the bond liability. Remember, the par of the bond is 1 million. But we gave 10,000 discount. And we also paid 35,000 as the underwriting commission. So the net amount of the bond is 955,000. Remember our previous lecture, the bond discount and bond premium and the bond discount it is shown as net of the bonds par value. Premium is added to the par and discount is deducted. So this is the par, less discount, and any cost on the bond issue, it is amortized just like the bond discount. I'm going to repeat. Issue cost is treated as if it's a bond discount, and it is amortized in the same way as the bond discount. So that is why we deduct the bond discount also, and we deduct this 35,000 of issuance costs also. What will happen as the time passes? When we amortize this bond discount, when we amortize this issuance cost and release these two on the income statement as an expense, our bond will keep going up. 960, 975, 983, 999, and finally, at the end of its life, the bond will have an exact $1 million book value. So it's not that the amount 955 would stay there. It will increase with the passage of time when we amortize this bond discount and when we amortize this issuance cost and we charge it as an expense in income statement. The point here I want to make is that this issuance cost is not charged as an expense straight away in the income statement. Rather, it is amortized share. Just like the way we charge depreciation, we amortize this bond discount and issuance cost to income statement, and the bond will jump from 955 to 1 million at the date of maturity. So the answer we have is 955 right now, and this 955 will go up. I told you bond accounting is something as a financing cost, as a charge, as a financing cost. Okay, now this is a good one. This is a good question. 4 zero coupon bonds each will pay 1,000 at maturity. The bond mature in either 10 or 20 years and have a current price either 300 or 500. So there are two bonds, or given here 4 bonds, each has a maturity price of $1,000. The bond either matures in 10 years or 20 years and have a current market price of either 300 or 500. Which of the following bonds has the largest yield to maturity? Bond 1 has a current price of 500. You pay 500. After 10 years, you get 1,000. Bond 2 is available right now for 300. After 20 years, you get 1,000. Bond 3 is available right now for 500. But in 20 years, you get full 1,000. Yusuf is right. And bond 4 is available right now for just 300 and it matures within 10 years. So this appears to be the best bond because the zero coupon bond is the best that is available at the lowest price and matures as quickly as possible. This is the lowest price and it matures as quickly as possible. You invest 300 now, very little amount, and you get $1,000 in 10 years. If you compare it with bond B, even you are paying the same amount, but you will get $1,000 after 20 years. So this is not good. So amongst these, bond D is the best option. Lowest price and the shortest maturity period. So D is the best bond. Okay, now this again is a good question. We will solve it using two approaches. The conventional approach, if you're comfortable with conventional bond valuation, or using the financial calculator. Let us read the information. It says young company issues $8,000 10% bonds dated January 1st, year 1, the issuance date. Interest is payable semi-annually, that is important, twice a year, on June 30th and December 31st. Okay. The bond matures in 5 years. That's the maturity period, 5 years. The current market rate for similar bond is 8%. This is the rate you will use for discounting. This is something I would always emphasize. Market rate, prevalent rate is used for discounting, and coupon is used for interest payment. This is a fairly straightforward idea, but students tend to mix these things up. The entire bond issue is sold on the date of issue. The following values are given. 10 periods, 4% interest rate. This is the present value for annuity, and this is the discount factor. Present value for annuity for 5%, and this is the discount factor. We will use all these and also using financial calculator. What amount of proceeds on the sale of bonds should Young report? Let us first use the conventional approach using the tables. We know the value of the bond is equal to present value of interest plus present value of principal. Let me draw the timeline. Remember, it is a 10 years bond. And since the interest is paid semi-annually, so we will shift it into 20 periods. 10 years will be 5 years, sorry, it's 5 years, 5 multiplied by 2, there will be 10 periods now. Period 1, 2, 3, 4, 5, 6, 10 6-month periods. And what is the interest payment? Interest payment is 10% of $800,000, that is 80,000 for the whole year. Since we are making semi-annual payments, so every payment will be 40K for 10 periods. So 0, 1, 2, 3, 4, 5, 6, 7, 8, 9, and 10. And on the 10th year, you will not only pay the interest, but you will also repay the original face value. Yusuf has calculated, very good. So the present value of the bond is equal to the present value of interest. 40,000 is the recurring amount for 10 periods. So you will multiply 40,000 with the annuity factor of 4%. Now, why 4%? Remember, 8% is the annual rate. Since it's a semi-annual bond, so you will divide 8 by 2, just like the way I divided 10,000 by 2. 5% of 80,000 is 40,000. 5% of 800,000 is 40,000. So 40,000 is the semi-annual interest payment multiplied by annuity factor for 10 periods at 4%, and which is given right here. 10 period 4%, this is the annuity factor 8.1109 plus. And then there is going to be a principal repayment at the end of the 10th year. Since it's the end of the 10th year, so there is going to be a single discount factor. Remember, when payments are repetitive, 40, 40, 40, 40, 40, 40, 10 times, you use annuity factor. And when there is a single payment, you use discount factor. This is the concept you will massively revisit in your section E. So, gentlemen, it's going to be the discount factor 10th year at 4%, which is going to be 0.67556. If I solve this all, I will get 40,000 multiplied by 8.1109 plus 800,000 multiplied by 0.67556. I get 864,884, which is a perfect match with your option D, because this is the conventional method using the tables. Now let us do the same question using smart approach, using the financial calculator. Let us see how we do it. So first we need to establish the inputs. They are going to be 10 periods because there is semi-annual payment. So periods must be multiplied with 2, 5 times 2, 10. Interest rate per period for discounting 8 upon 2, 4%. Present value, something we want to calculate. The payment, interest payment, 10% must be divided with 2, just like the yield to maturity was divided with 2. 10 by 2 is 5. 5 times 800,000, it is 40,000. And the face value is minus $800,000. You just need to plug in these inputs and you will be able to find your present value. So your number of period is 10. 10 is equal to N. Interest rate per period is 4. 4 is equal to interest rate per period. Payment is going to be $40,000 negative. For the company, it's an outflow. Negative 40 is PMT. And 100,000, sorry, not one, $800,000 is the face value. Negative 800 at the end of the 5th year or the 10th period, it's FV. So compute PV, it is 864,887. 864,887, just $3 off. Just $3 difference. So still the result is okay. Yes, exactly. That's Ms. Maham. That's the semi-annual approach. So 864,884. That makes D to be the correct option. What else? What else? Okay. What is the price of a 10-year, 10% coupon bond with 1,000 face value if investor requires 12% return? Assume annual coupon payments. Straightforward question. N is 10. Interest rate per period for discounting. This is the coupon at which the interest is paid. This is the rate we should use for discounting, 12%. Present value, the bond we want to calculate. The interest payment is calculated coupon multiplied by the face value, that is 100 negative. And when the bond matures in 10 years, the face value is negative 1,000. Just plug in the numbers and you will get your answer. 10 is N. Then we have 12% as your interest rate per period. Then we have 100 negative as your payment. And then 1,000, the face value, negative at the end of the bond maturity. CPT, PV, it gives you 886.99, which I believe is a perfect match with the option A. 887. So this is what you would be most likely tested on your exam. Let's see if we have some good questions there. Okay. In calculating the total value of the bond, we know the value of the bond is equal to present value of interest payments plus present value of principal. So in calculating the total value of a bond, how much does $1,000 to be received upon bond's maturity in 4 years add to the bond's value? This factor only. We just have to find the present value of the principal, not interest. So he says, find out what would be the present value of the principal that will be added to the valuation of the bond. Simple, you have to find this. So I'm sure you know, this is the timeline. Year 1, 2, and 3, and 4. The bond matures in 4 years, and this $1,000 has to be paid at the end of the 4th year. So you need to find the present value of this $1,000 by multiplying this 1,000 with the discount factor of 4 years. For what rate? For the discount rate, 6%. So if you find this number, you will find this number to be 0.792. In 4th year row and 6% column, you will find this as 0.792. Multiply this with 1,000, it will be 792. That makes C to be the correct option. And I guess that's all. That completes your bonds valuation questions.